All right, let's dive right into this explainer. Today, we're going to demystify some of the most fascinating and sometimes misunderstood market mechanics out there. And to do that, we're going to follow the journey of a hypothetical trader we'll call Little M. You know, if you've ever stared at a crypto chart and just felt totally overwhelmed by those dizzying highs and terrifying crashes, you are definitely in the right place. We're going to break down exactly how seasoned traders navigate these wild swings, and honestly, more importantly, how they prepare for them before they even happen. So here's the literal $1,000,000 question. Most people get the classic investing playbook, right? You buy low, you sell high. It makes total sense. But the real secret of the financial markets, the absolute game changer that separates everyday investors from the pros, is knowing what to do when an asset like Bitcoin is sitting at, say, $100,000 and you are absolutely convinced it's about to tank. How do you actually turn a massive market drop into a profitable opportunity? Well, here's our game plan for figuring that out. First, profiting when prices fall. Second, executing a short trade. Third, futures and turbo trading. Fourth, a step-by-step futures trade. And finally, those absolutely crucial safety rules. Let's get into it. Part 1. Profiting when prices fall. Okay, before we start looking at charts or mashing buttons, we need to lock down a foundational concept. It's called going short. Instead of buying an asset and crossing your fingers that it goes up, you initiate a trade by selling. You're basically placing a highly calculated bet against the market. If the price drops exactly like you predicted, you profit from that downward slide. So in our scenario, Little M has a pretty modest trading account of just $50. He's staring at Bitcoin at $100,000. He thinks things are way overheated, and he wants to capitalize on the drop he knows is coming. Now, check out the mathematical discipline here. Little M creates strict entry and exit points before he even touches his phone. His entry price is exactly where the market is at, $100,000. His take profit, which is the exact point he cashes out his winnings, is set at $95,000. But crucially, his stop loss is set at $101,000. This is his safety net. If he's wrong and the price suddenly pumps, the trade automatically closes so he doesn't get racked. And finally, his lot size is 0.01, which is the smallest, safest size for his $50 balance. This isn't guessing, guys. This is strategic planning. You can basically think of going short as the exact mirror image of buying or going long. When you go long, you profit when the price goes up, right? So you put your protective stop loss below your entry to catch any sudden drops. But when you short, when you sell, you profit when the price falls. That means your stop loss has to go above your entry price to protect you if the market unexpectedly shoots to the moon. It's just a simple flip in perspective, but the actual mechanics of managing your risk, those remain exactly the same. Moving on to part 2, executing a short trade. So how do we translate that perfectly mathed out plan into reality? Well, inside a platform like MetaTrader 5, Little M opens the Quotes tab and picks the Bitcoin to US dollar pair. He locks his volume in at that ultra-safe 0.01. Then he types in that heavily planned safety net, the stop loss at 101,000 and the take profit at 95,000. Once all that is set, he finally hits that red sell by market button. By doing it exactly this way, Little M safely enters his short position, completely protecting his $50 while just letting the trade do its thing. All right, part 3, futures and turbo trading. Now let's look at how this builds into something even more powerful. If standard spot trading is like driving a sensible everyday sedan, futures trading is basically strapping a rocket booster to your portfolio. It lets you profit on both those upward and downward swings we just talked about, but with significantly enhanced capital. You're no longer just limited to the $50 sitting in your account. You can punch way above your weight class. And the fuel for that rocket booster? It's called leverage. You can think of leverage as temporarily borrowing superpowers from the exchange to massively amplify the size of your trade. It magnifies your potential profits, but, and this is a huge screaming but, it equally magnifies your potential losses. Let's break down the math on this with a nice round number, 100. This perfectly illustrates how this superpower actually works. If Little M uses what we call 10x leverage, he only has to put down a tiny $10 risk from his $50 account. But that $10 instantly transforms into $100 of total trading power. He is literally controlling a $100 position with just a $10 bill. However, as we all know, borrowed superpowers come with some pretty intense conditions. To trade futures without blowing up your account, you absolutely must understand 3 things. First, margin. This is the actual real money, like little M's 10 bucks, that backs the trade. Second, liquidation. This is the danger zone, folks. If your trade goes too far in the wrong direction, the exchange will forcibly close your position, and poof, you lose your entire margin. And finally, the funding fee. Think of this as a tiny little rent fee you either pay or receive for keeping your trades open over time. Grasping these concepts is literally the difference between thriving and going to zero. Part 4. A step-by-step futures trade. Let's walk through exactly how Little Mem deploys this on an exchange like MEXC. He opens the Futures tab for BTC to Tether and makes a very critical safety choice right off the bat: isolated margin. This ensures he's only risking the money assigned to this one specific trade, setting his leverage to 10x. He sets a market order, types in his $10 margin, locks in his take profit and stop loss, and then taps buy or sell depending on where he thinks the market is headed. And remember that whole mirror image concept from earlier? Yeah, it applies perfectly here too. If he's certain the market is about to drop, the setup is identical to a long trade. All that careful prep, the isolated margin, the 10x leverage, the stop loss, it all stays exactly the same. The only difference is that at the very end, he just presses the sell/short button instead. And finally, part 5, the crucial safety rules. Look, before anybody starts messing with turbo trading, we have to lay down some ultimate survival guidelines. These 5 rules, absolutely non-negotiable. First, start small. We're talking risking $5 to $10 max. Keep the training wheels on with 5x to 10x leverage. I literally cannot stress this next one enough. Always, always set a stop loss. Third, avoid the pure chaos of trading during major news events. And finally, and honestly, this is the hardest one to master, never revenge trade. If you take an L, do not immediately jump back in because you're mad. Close the app, go take a walk, and plan your next move calmly. This quote pretty much sums up our entire explainer today. You can make money when price goes up or down, but only if you plan before pressing the button. It's never about guessing. It is 100% about strategy. Discipline and planning have to happen before you take action. Stuff like shorting and leverage, they are completely neutral tools. They only make you money if you put in the preparation first. So, as we wrap this up and you get ready to navigate these crazy markets, ask yourself, do you truly have the discipline to plan your exits before you ever touch that entry button? The mechanisms are totally there for you to profit in any direction. But honestly, the biggest risk isn't the market suddenly dropping. It's you jumping out of the plane without checking your parachute. Build your plan, master your own psychology, and trade safe out there.